Indian startup IPOs have shared a commonality. They started out as stock darlings on the bourses as soon as their listing plans were announced, only to transition as memes later on. The reason for such memification being the huge collapse of value from the initial listing. In fact, Paytm, Zomato, and Nykaa, the startups that spearheaded the wave of startup IPOs, have all collapsed over 50% on the stock market since their IPOs. No wonder this widespread destruction of shareholder wealth has led to many investors going wary of unreasonable valuations that startups list at. Hi guys, welcome to Upsurge.club, where we talk all about stock markets and of course, the startups that might also become a part of it. Also, before I move ahead, make sure you watch the video till the end because we have a surprise gift for you. One of the major reasons why Mamaearth faced a lot of backlash is because of the valuations that it is demanding. The staggering number is 24,000 crores. This is 1700 times its earnings. Many have even voiced their concerns that Mamaearth is another Paytm IPO in the making. With the D2C brand being valued at a revenue multiple commanded by SaaS companies, Mama Galaxy IPO is a meme already. In fact, such was the buzz around its valuation that the co-founder Ghazal Alag had to take herself to social media platforms to settle the concerns. Is this criticism justified? Or will Mamaearth create immense value for its shareholders? Let's uncover the business of Mamaearth while also identifying the various risks presented by the initial public offer. Mamaearth was born as a result of the founder's personal brush with the problem, that of finding safe, toxin-free baby care products. In 2015, the Indian baby care market was quite nascent. As a result, generic products which contain parabens and sulfates had to be used for baby care. There was no other option except from getting non-toxic certified products from the US, which was costly and inconvenient affair for the Ghazals. It is this gap that they identified in the Indian market, and in June of 2016, Mamaearth was born as a trusted mum-baby friendly brand. Right from the start, they wanted to create a purpose-driven brand. They successfully built that emotional connect with consumers, which helped them establish themselves against big brands. In fact, the title of Ghazal Alag as the Chief Mama Officer reflects how important moms are for the company. Also, it had everything working for it when it launched, both infrastructure-wise and demography-wise. Flipkart had already laid down the logistic rails for the proliferation of D2C. Moreover, with the great success of the D2C model in the US, the same was expected to replicate in India. Geofication was already underway, with cheap data bringing millions from all tiers of the internet. Nykaa, Zivame, and Lenskart were already gaining steam. India's economic landscape also looked bright. Growth in GDP resulted in a rising middle class and upper middle class that drives private consumption. The childcare market in India was pegged at $3 billion with a healthy growth rate of 15%. However, with the presence of large giants in this space, distribution was always going to be a tough nut to crack. As a result, Mamaearth opted to distribute its products via Flipkart, Amazon, and FirstCry, which blitzscaled into the next stage of growth. The way it cracked its online distribution was even more rewarding. With content being created and consumed at a rapid pace and a huge scale, they partnered with content creators to integrate Mamaearth and its products in their content. This improved their discoverability. Also, to mention that Mamaearth achieved what every Indian unicorn dreams of: profitability. In FY22, they generated a profit of 14 crore. Despite huge spends on marketing and customer acquisition, achieving profitability would be attributed to thick margins that it enjoys. With parents willing to spend as best as they can to ensure the best care for their babies, they enjoyed a healthy margin of 65%, one of the highest in the industry. Their revenues have already grown 8 times in the last 3 years to Rs 943 crore in FY22. Going forward, rising middle class, increasing market share, lower cost of raw materials, product innovation, and excellent market positioning are expected to propel the growth of this D2C giant. However, not all is well with the Mamaearth IPO. First, it suffers gravely from one of the biggest ailments in the D2C e-commerce industry: the lack of customer loyalty. They have maintained a return on ad spend at 2.5, which is pretty average. Over the years, as it gained traction, one would have expected this number to be close to 4 to 5, which the likes of D2C brands like Bewakoof have proved is achievable. They are still struggling with retention and continue bleeding money. Moreover, high dependence on third-party platforms coupled with a lack of strong tech play and economic mode add to the concern of its future growth. The second concern is from a valuation perspective. Listing at the said valuation gives Mamaearth a PE multiple of 1714x. To put that into context, HUL, P&G and Godrej, the other players in the industry, trade at a PE of 50 to 90. And if you reason that startups would command a higher PE, let me tell you that Mamaearth's PE is around twice that of Nykaa, which was 979x. Moreover, after being valued at $1.2 billion in January 22, it's seeking more than twice that valuation in its IPO, with no significant reason to justify the same. Even internationally, most D2C IPOs have miserably failed. What's more interesting is that out of the 2,900 crores being raised, just 400 crores involve a fresh issue of shares, while the other rest constitutes an offer for sale. At this juncture, let's understand what's an offer for sale and how is it different from fresh issuance of shares. An offer for sale is an arrangement for the transfer of shares of a company from the promoters to the public. Thus, it involves mere transfer of ownership. The entire proceeds from such sale go to the promoters and not to the company. It is used as an instrument to provide an easy exit to promoters and institutional investors. On the other hand, a fresh issue of shares involves creation of ownership against funds raised from the public, the proceeds of which are used for business expansion and diversification. Now taking Mamaearth's case, just Rs 400 crores of the funds raised would be used for business, while the rest used as a means to give exit to the Alags, Snapdeal founders and even Shilpa Shetty, who had supposedly made Rs 80 crores from her initial 0.75 crores stake. While exits are both good and important, exiting at such high valuations at the cost of retail shareholders casts doubt on the promoter intentions and reflects their short-sightedness and the lack of conviction in Mamaearth's future. It's extremely difficult to create a consumer brand, especially in a competitive category like childcare, and Mamaearth must be appreciated for its product quality and market positioning. However, what's important for investors is to focus on business and valuation fundamentals, not being caught in the hype. I hope you enjoyed this case study from us. And here is your gift. YouTube 10. Use this coupon code and get access to our premium membership at Upsurge.club for a 10% off. Happy learning with us!